Well, hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's a brand new week and of course after the 2% cut that we saw on the Wall Street last week, this week looks like, we will be in for some volatile times given the fact that we have the Federal Reserve rate decision later this week and of course we have the BOJ Bank of Japan rate decision as well that will be coming out tomorrow. So lots of cues to digest, lots of stocks to watch out for, lots of result reactions in the form of Reliance Industries. You have NTPC that reported earnings over the weekend. So we'll be focusing in on that as well, and lots of other stocks that will be in focus today. We will be discussing a lot over the next 30 minutes or so, but of course we'll also be getting all your stock related queries answered by a technical expert on the show. So if you have any queries, send them in to us on our YouTube feed as usual and we'll try and take them up. But before we go any further, let's take a look at the top headlines at this hour. Wall Street ended the week lower with S&P 500 entering into the correction territory. Meanwhile, the Nasdaq is off over 12% from its 2023 highs. All eyes, as I mentioned, will be on the Fed's rate decision where the central bank is expected to hold on to interest rates. Asian markets start a brand new week on the back foot. The Nikkei is down nearly 1%, while the GIFT Nifty, however, has managed to, stage a comeback and is trading higher by about 50 points or thereabouts, indicating a mildly positive start for the Indian markets. Crude prices eased from weekly highs hit on Friday. Brent slips below the $90 a barrel mark as demand prospects remain uncertain amid geopolitical worries. Reliance Industries numbers beat estimates on most counts. Retail business sees stellar growth while telecom arm Jio remains stable. Earnings from the oil to chemicals business were also above street expectations. Most brokerages rather have retained a buy rating on the stock. Dr. Reddy's reports a mixed set of numbers in the second quarter with the US business meeting estimates. Meanwhile, BPCL's numbers beat expectations as the refining vertical outperforms. However, marketing margins continue to remain weak. And among other numbers to track today, watch out for quarterly earnings from UPL, DLF, TVS Motor and Marico. Well, on that note, let me bring on board my first guest for today. Joining me is Feroze Azeez, who's the Deputy CEO at Anand Rathi Wealth. Great to have you on the show, Feroze. As usual, I want to check in with you. Last week, we saw the Nifty, down by about 2.5%, 6 incessant days of selling, but Friday was a bounce. Going forward, do you think that this was a dead cat bounce, or do you think, the worst of the selling is perhaps behind us?
Good morning, Nandita. Point one, yes, like you rightly said, we had 6 successive days of market correction. But if you look at it, it was also the month-end expiry. 26th October was the last Thursday of this month. When you saw the kind of carnage in the market, which is consecutive days, you also like to see what kind of roll cost happened in that expiry. If you see the roll cost or the futures ended at premium, November futures ended at a premium about 120 rupees, which is marginally more than the cost of carry from a treasury bill perspective. So that automatically said that we were oversold, and that's why the bounce, point one. Point two, when it comes to markets, people generally digest the gains which have come in the past. But if you look at, we are just about 6.6% lower than the peak. If you look at the last 22 years, 23 years of history, the drawdowns every year average have been 14, with 4.8 being the minimal. So I don't think this is a correction which is substantive enough for a person to be worried from a investor standpoint. Because if you're looking at the average of the last 22 years, leaving the GFC, which is the global financial crisis, and the COVID years, which were exaggerated years, you leave them apart and there's a 14% drawdown from peak to trough each year. And if you include them, then the drawdowns go to almost about 17-18% average a year. So I think we are not in any zone of a sensible correction, I would say, because 6.6% from the peak is not such an exaggerated move from a profit booking standpoint.
Right. Speaking about the earnings season now, Feroze, since we are in the midpoint of the earnings season, till now we have, we have numbers. We've had numbers from the IT pack. We've had FMCG report numbers. We have had the private banking names as well reporting their numbers. So among all the sectors, post earnings season, which one would you say that is worth a look at the current juncture? Because given the fact that IT, was not such a major disappointment as the street was already factoring in weak set of numbers, and of course we saw what happened with Infosys, trimming the higher end of the guidance. So after earnings, how is the entire IT pack looking to you? And what about the banking pack? Margin pressure was something that the street was factoring in for banks as well. So between the two sectors, which one would you pick right now?
So if you look at, I personally think IT was oversold. If you look at a few months back, even bad results the previous quarter were resulting in stocks doing well on those specific days. A clear indication of being in the oversold territory is bad results resulting in some degree of up move. So that's a great sign of a reversal. Point one, I think the kind of IT spending which has slowed down, especially from the Europe, that has been factored in. Point two. Point three, I think that IT has the potential to deliver an alpha over Nifty by about 4-5% in the year to come. It's very important to, when you look at sectors, you have to have targets in terms of the differential performance with Nifty, especially for a major sector like IT. And I think about 4-5% alpha. Last 1 month, it has underperformed Nifty. But I think on a three-month basis, it's outperformed by about a couple of percent. So I think in a year's time, Nifty IT has the potential to deliver about 4-5% alpha. All your sector calls, if they can add up to getting you 3-4% alpha on Nifty, that's when the game becomes interesting. And I personally think banking as a sector is a little high beta sector. I personally think that you have to be very choosy in the high beta sector. From a business model standpoint, because everybody has different USPs and strengths, and especially in a year preceding election year, I would be very, very cherry picking the high beta sector, especially given the fact that that sector holds about 34% weight in Nifty currently, BFSI.
Right. But what about the auto pack? I think we've seen stellar numbers coming in from Maruti. Auto sales have also been picking up. Of course, festive season is upon us. Volumes have been improving. Do the auto names warrant a buy now at the current juncture?
I think in another couple of months, I think auto would be a great bet because the rural spending is going to go up. The government has planned to advance the spending in terms of the capital expenditure and finish most of it in this calendar year. About 80% of it, 48% growth in capital expenditure has been seen. I personally think auto sector, I would not go bullish today because if you have to beat Nifty, you have to tweak the weights. I would not be overweight auto at this stage.
All right, not overweight at on autos at the current juncture. But what about sectors that are over-owned by the FII community? Of course, at the start we spoke about how FIIs have been sellers now. Any sectors that are an avoid aside of metals for one, given the fact that we've seen quite a bit of grubbing coming in when it comes to the metals basket?
Yes, you're absolutely right. FIIs have a large role to play in a specific sector depending on their ownership and the cash flow. FIIs over the last 10 days have sold about 6,000 crores. They were largely positive for the first 5 months, except August and September. I think they have been marginally negative. 6,000 crores is not a large number. FDI has outdone them by 10,500 crores of inflow in the same period of the last 10 days. I think, like you said, I would say metal is the one sector which is reasonably cyclical, and I would stay out of it. And I think I would be bullish on pharma. And I think not just from a perspective of the next 1 year, but from a long-term perspective, I would be very, very bullish on pharma because I think most investors don't find it easy to get in and get out of the sector because it's incidental that you give the advice to exit as well. So I think some sector which you can hold for a long period of time would be a pharma kind of sector.
All right. I also want to get your thoughts on mid-caps. When we see some kind of correction, of course, mid-caps are the ones that bear the brunt of that correction, right? So what are you advising your clients in terms of, stock picking? Would you say time to stick to large caps, perhaps, or even look at some of the mid-caps with good fundamentals? What are you advising your clients now?
Yes, Nandita, I personally think we've oversimplified the mid-cap and small-cap category. It's a very large universe. So if you look at large caps, you can be very generic when you're speaking about the top 100 companies of the country. But if you look at mid-caps, especially from mutual fund investor standpoint, it is the Nifty 150 mid-cap. The formation of the index itself is reasonably complex. And I think it's little known that why in the NSE 500 or the small-cap 250 index, there is a 4,000 crore market cap and some company with a 8,000 crore market cap is not even in the top 500. Because the formation of the index, if you look at the formula of it, a company needs to be in the top 350 to form a part of a 500. So I personally think index in the small cap and the mid cap index have generally been lagging behind because the way they are constructed has a lag impact of several businesses doing very well and then they're getting included and a person missing out the rally. So point one I'm trying to make is if you have to be in the mid cap is still okay. If you have to be anywhere close to small cap, the name of the game is to be very specific and at least understand how the index is constructed. If you look at the top 10 weights of the index, they're about 16-17% if I'm not wrong. So I would say a concentrated top index bet is a better strategy in the small cap space. That's one thing which I'm saying on the basis that most index fund investors itself don't know the logic behind a 3,000 crore being a part of NSE 500 and a 6,000 crore company not being a part of NSE 500. That's because a company, if it has to find itself into NSE 500, needs to be a company which has been at 350 rank as per total market cap before it's even considered to get included.
All right. Lastly, anything that you like in the electronic manufacturing space? This is one pocket that the street is fairly bullish about. The likes of Dixon Tech have reported great set of numbers. So anything you're spotting here, and of course in the capital goods sector as well, given the fact that we are entering an election year.
Yes, capital goods are very, very positive. Not very qualified to comment on the electronic sector. But yeah, capital goods, I think, will give you that fillip because it's also a high beta sector. And I think kind of capital expenditure will result in several infrastructure themes and capital goods doing very well. Of course, you have to buy it not in the positive side. You have to buy things that are tough, which takes more courage because you have to be contrary when you're wanting to pick sectors and have active weights on sectors with the objective of beating an index. I personally think courage becomes a very important investor attribute. So any in sector which has done not so favorably over the last couple of quarters is the one which comes on the anvil for a choice.
All right, be courageous. I think that's the advice coming in from Feroze. Feroze, on that note, it was great speaking to you today. Look forward to touching base with you sometime soon. But awesome to have a great chat with you this morning.
My honor.
Well, with that, let's shift focus and get on to some market technicals now. Bringing on board, joining me rather today is Rajesh Palviya of Axis Securities. Great to have you on the show as usual, Rajesh. Given the fact that we've started the November series on a positive note after a continued bout of selling, what are you spotting in terms of levels when it comes to the Nifty and Bank Nifty, particularly for today, and what are your expectations for the November series going forward?
Good morning, Nandita. So we have started a November series on a positive note, as though the October series has seen a pain in terms of Nifty as well as in the Bank Nifty. Both indices were corrected significantly. Both indices were moved in the oversold trajectory. So it's a kind of technical pullback which we are seeing in the market. I think some more upside we can see towards the 19,000. 150, 19,200, that's the area where we are focusing again, because that's the major supply zone as of now for the Nifty based on the call concentration. So until Nifty not able to cross 19,200, there won't be any significant short covering action will play out at this moment. So one should look at the 19,200 as a supply zone, and where if you have bought at lower levels, you can look to book some part of profit around those levels for Nifty. On the downside, immediate support area is at 19,000 as well as 18,950. These two levels needs to be watched very closely. If again we breaks below 18,950 level, then possibly again we may see further more supply pressure, and then Nifty can show further more weakness from current level. On the Bank Nifty, there was an attempt of recovery, but still Bank Nifty is trading below 200-day moving average. That is giving a sign of bearishness in terms of trend for Bank Nifty. So until Bank Nifty not manages to regain again above 43,500 level, whatever pullback we are going to see, minor pullback, are going to get again supply pressure on the higher side. So 43,000 and 43,200, these are the area where again one should look at to book some profits. On the downside, 42,500 is the key important support area for Bank Nifty for today's session.
All right, 18,950 on the Nifty, and of course the levels that Rajesh mentioned to watch out for on Bank Nifty. But before I, take up some viewer queries, let me get in your thoughts on Reliance Industries. The numbers came out on Friday post market hours. Of course, it was a beat on most counts. You saw healthy numbers from Geo, retail, in fact, even the O2C business. In fact, if you look at the brokerage views on the stock, pretty positive. Jefferies has maintained a buy rating, target price at 3,000 rupees. It says that the retail segment is improving and the subscriber additions for Geo have been pretty healthy. Nomura, in fact, also has a buy rating, target price at 2,925 rupees per share. And it also mentions that there's been a healthy growth across segments, and refining margins, have been partly offset by the decline in petchem. The net debt has moderated, and that is something that the brokerages are saying is a big positive for the company. And Morgan Stanley, of course, also maintains an overweight rating, target price at 2,821. Looking at the charts, of course, we know that on a YTD basis, the stock is down. Even on a 6-month basis, we've seen, losses of somewhere around 6% or thereabouts, 7% or thereabouts. But Friday's session, we saw some bit of gains coming in. Do you think after the positive numbers, we can see the stock gain more momentum going forward? What are the charts saying?
So, Nandita, if you look at the different time frame, since last 3 months, the stock is forming lower high-low formation. That's the corrective move we are seeing on the medium-term chart. On the near-term chart, the stock is slipped below to 200-day moving average. But on the weekly chart, stock has formed a hammer kind of formation with a long lower shoulder that clearly shows that some buying interest was there at the lower level. So I think Reliance is the case of pullback in today's session. Might be stock can show some pullback towards 2,300. That's the first level one needs to watch on the pullback. If at all stock crosses about 2,300 level, then there would be short covering. We can see a triggering of short covering, and then these may lead to further more upside towards 2,340, 2,350 kind of area. So on today's basis, 2,300 is the upper level where one can look at on the higher side, and on the downside, the important and major critical support area on the downside is at 2,220. This level needs to watch closely for today's session. If these levels are intact, then possibly we may see gradually stock will start recover, because near-term to short-term setup is clearly suggesting that indicators are in oversold trajectory. So some short covering action may takes place in Reliance Industry. 2,300, 2,220, these two levels needs to watch for today's session.
All right, those are the levels to watch out for on Reliance Industries. Before I talk about the stock of the day, I also want to take up some viewer queries that are trickling in this morning. We have a query coming in from Debu K. Wants to know your thoughts on Carborundum Universal. Any thoughts as to whether one should look at buying this stock now? How should one strategize when it comes to this particular name?
So stock is in corrective move in this correction. Since last 3-4 trading session, stock is hovering around its 200-day moving average, that is at around 1,080 level. So 1,080 needs to watch very closely. If it slips below to 1,080 level again, then possibly this correction may extend towards 1,030, 1,020 kind of level on the downside. That is the previous swing low of August 2023. So overall structure is weak, but at this juncture, 1,080 needs to watch very closely. If stock at all holds this level, then some pullback action we can see towards 1,120, 1,140 kind of level. That's the near-term setup which we can see at this moment for Carborundum.
All right, those are the levels to watch out for on Carborundum. Hope that answers your query. We also have a query coming in on Reliance Industries. Rajesh Veera, we have already discussed this stock. You can perhaps rewind the feed a bit and check out what Rajesh had to say about it. But let's take up the next query. This one is coming in from Ujjwal and wants to know your thoughts on Havells, Rajesh. What are the levels you'll be watching out for on this particular counter?
So stock corrected significantly in last series, and we have seen again a lower high-low formation for last 2 consecutive weeks. Though stock is in oversold trajectory, if we look at the daily chart, there is a long lag. The doji kind of formation is already taken place. So that's the sign of reversal on Havells on the near-term setup. But yes, structure is weak. So one should, if anybody wants to buy this stock in this oversold trajectory, one should keep a very strict stop loss of 1,230. if you are buying at this current level, there is a high probability that if market moves further higher or if market continues further more pullback action, so there will be again, same pullback action we can see in the Havels. But on the higher side, 1300 is the critical level to watch for. That's the supply area at this moment. Until the stock not crosses above 1300 level, there will be again supply pressure. Above 1300, there will be short covering action in the stock. So you can buy with stop loss of 1230 for upside target of 1300. If it crosses 1300, then next target would be 1340.
All right, 1340 is the target level suggested by Rajesh on Havels. But let's take up a query on BEL. Manish Sagar wants to know your thoughts on this, Rajesh. The company reported its numbers, over the weekend. Even though numbers are, higher than what we saw last year, they are still below estimates. And, if you talk about some of these defense names, of course, the rally that we saw in the first half of the year has kind of fizzled out. But on Friday, we saw BEL, gaining somewhere around 2.5% or thereabouts in trade. Do you think it can regain the momentum that it has lost over the last few months now? Or, what is the chart setup looking like for BEL?
So overall, long-term structure for BL is bullish, and we are bullish on the defense stocks. BL is also enjoying its all-time high trajectory since last 3 months. Yes, there is a consolidation. Post rollover, yes, market is showing that some more upside. We can see this BL in the BL almost stock is hovering near to its 100-day moving average. So I think 128 should be your stop loss to buy, or at least to hold your position on the long side. Possibly stock may move further higher towards 140, 145 kind of zone in this pullback action. That's the again area where one should review it. 145 is the major supply zone at this moment.
All right, that's the view on BEL. But we have a query coming in on Dixon Tech from Durga Das Saha. Dixon reported great set of numbers in the second quarter. Now, going forward, do you think it's the right time to buy into this stock, or wait for further correction, or wait for dips to get into it now?
So I think overall structure on the near-term, short-term basis is on the bullish side. Stock is trading above to all its near-term, short-term moving averages. That clearly shows that strength is there. Series of higher top, higher bottom formation on the daily chart. I think if at all any correction comes in the stock towards 50 to 50, that's the again important level to again re-enter in the stock in the decline. But overall structure is looking weak, bullish, and I think on the weekly chart, if we analyze this stock is moving in upsloping channel. That clearly shows that I think trend is likely to remain on the bullish side. On the higher side, 5450 is the immediate supply zone. If it crosses those levels, then maybe this stock can scale up to 5600 kind of level also. So I think those who have already bought or wish to buy this stock, 50 to 50 should be your stop loss. Buy an equivalent in the decline. And upside target is 5450 and 5600.
All right, 5450 and 5600 upside targets on Dixon. With that, I think I just have enough time for one more query. This one is on IDFC First Bank. Two people have written in on the same stock, G. Manjunath as well as Kartikeya. Manjunath wants to know your thoughts on IDFC First Bank for the next 2 years and whether or not is the right time to accumulate. And Kartikeya wants to know your thoughts on the stock after the earnings. Of course, I think among the banking names, most of them have reported numbers, but SBI is the big one that we'll be watching out for and reports its numbers this week. But post the numbers between an HDFC Bank, ICICI Bank and IDFC First, which one is looking most attractive on the charts now?
So first we discuss IDFC Bank, IDFC First Bank. That stock is slightly slipped below to its 100-day moving average. Some corrective move is happening in the stock. The overall structure is on the bullish side. Almost stock is trading near to just slipped from its all-time high trajectory. I think in this correction, 83 and 82 is the important level to watch for. If at all stock not breaks below 82 level in this corrective move, I think again it's a buying opportunity as overall structure for stock is on the bullish side. So 82 is the area where I'll ask them to put their stop loss for trading or short-term investment position. On the upside, once a stock crosses above 94 level, then possibly this stock may scale up to the level of 100, 105 also. If we talk about SBI, SBI also shown some pullback action from recent low. Stock is having major and critical support area at 550, 545 zone. So until the stock not breaks below 540 zone, I think there is again opportunity to buy this stock, as the whole market is showing some pullback action. And I think for 1 or 2 day trading perspective, some pullback action we can see in SBI also towards 580, 585 zone. So where again, one can either review the stock or one can book partial profit around those levels. But keep your stop loss at 540 or whatever you are buying at the current level.
540, an important support level for SBI. This wraps up our query segment for today. But of course, if you couldn't take up your query, don't get disheartened. We'll try and take up your query in tomorrow's show. But Rajesh, before I let you go, what are you flagging off for viewers this morning?
So I think, Nandita, one should look at the automobile space, and that's Tata Motor is looking promising. Post rollover activity, stock has shown good buying interest again. Stock is holding its 50-day moving average. We believe that Tata Motor can show some upside momentum towards 665, 670 zone. One can buy with stop loss of 625. Another stock that we like is DLF. Whole real estate space is showing good strength. Even in the previous session, we have seen most of the real estate stock have recovered from their recent low. DLF is looking promising. Stock is holding about to its 50-day moving average. Looking at the reversal in the last session, we expect further more upside towards 555, 560. One can buy with stop loss of 525.
All right, those are the recommendations coming in from Rajesh this morning. With that, Rajesh, as usual, thanks a lot for taking out time and joining in this morning, and of course addressing all our viewer queries so patiently. Well, with that, we are at the end of this edition of Morning Trade. But before I go, just want to remind our viewers that we will be seeing a Cello World IPO kicking off for subscription today. It's a 1900 crore rupee IPO, and the price band has been set between 670 to 648 rupees per share. Of course, you can log into moneycontrol.com and see what experts have to say on whether or not you should subscribe to this issue or not. But with that, we're completely timed out on this edition of Morning Trade. Thanks a lot for tuning in, but don't go anywhere, because coming up next is Opening Trade.